This is Dave Andrian at Artisan Radio. I'm here today with Dan Burney, the broker of record for Artisan Realty in the Philadelphia metropolitan area.
What's your first question there, Dave?
Well, today you said you wanted to discuss three popular types of mortgage options. I believe they were conventional, the FHA, and the USDA.
Right.
So tell me about the conventional mortgage.
Okay, great. A conventional mortgage is for someone, let's say someone's buying a $100,000 house and they have 20% down, which would be $20,000. If they were to put the $20,000 down, they would avoid paying something called private mortgage insurance, often referred to as PMI. The private mortgage insurance on a payment for a $100,000 loan would probably be about $150 or $200. So if they could just get that 20% down and create a conventional mortgage, they wouldn't have to have that additional $150 a month payment. They can buy a house with conventional loan with 10% down, even 5% down, but that private mortgage insurance fee would then kick in and they'd be paying another $150, $200 until that house appreciated enough so that the mortgage would be able to be recreated without having that private mortgage insurance. So basically, if you have more than 20% down and you want to buy a house, if you want to avoid private mortgage insurance altogether, you can go with a conventional mortgage. A conventional mortgage is what they might refer to as a vanilla or plain or normal mortgage in the terms of the way most people look at mortgages. It's also one that's not supported, it's not underwritten, and it's not there's no money given to it from the federal government. This is a private lender lending you money to buy a house. Over time, my statement I'm about to make will change, but over time, the conventional mortgages have sometimes been the ones where the lender will accept any property. They don't care about repairs. Over the last 5, 6, 7 years, the lenders with the conventional mortgages have been just as concerned with repairs as FHA and USDA, the other loans we're going to talk about. And so therefore you can't escape having the seller having to do repairs because you choose a conventional mortgage. They're pretty much all on the same par right now. Because the conventional mortgages make up a larger percentage of mortgages in the country, a good mortgage broker or banker would be able to get you probably a better rate on a conventional mortgage, and they certainly will have more banks to shop at, and even private lenders. People who are looking to lend money to help people buy houses will be looking to do conventional mortgages first because they like that 20% down feature of it. Think of it from the person lending money. Would you give someone a $100,000 house to buy a house that might go up and down in value, or would you be more comfortable giving them $80,000 for a house that might go up in value? From the lending perspective, it's a much more comfortable position. So most times when someone goes out to buy a house, their first thought, their knee-jerk reaction is to try to get a conventional loan. And then if they find that they don't have the 20% down, in order to avoid that private mortgage insurance, they have additional choices, which we're about to talk about. What was the other choice that we're going to talk about? FHA?
So the next one would be FHA. First of all, what does that even stand for?
FHA, Federal Housing Administration.
Okay.
So this is our federal government kind of coming to the rescue of home borrowers. If it wasn't for the FHA and another group called Fannie Mae, it would be very difficult for people to be able to borrow money for a house. In other countries in the world, the government doesn't back the mortgages. And when I say back, they don't promise that if the buyer doesn't repay the loan that they won't have a total loss. And in the United States, through lots of different sources, especially the FHA, the government will guarantee to the lender a certain portion of the loan. So if, Dave, for example, you went out and bought a house and you stopped making your payments, you lost your job, or other events happen, the government will contribute money back to the lender to make them comfortable. They probably know that they have enough money to resell their house, satisfy the loan, and move forward without getting hurt too much. So FHA is a federally backed loan. The beauty of an FHA mortgage is two unique things. One is, and the most important thing is, you can put 3.5% down to buy a property. So I'll translate that. If someone's buying a $100,000 loan, they could put $3,500 down, or 3.5%, and that's it. They don't have to come up with a 20% amount that you would have had to with a conventional loan. So if you can get into a house with 3.5% down, that's pretty attractive. There's additional things called closing costs we'll take a look at. Generally in the Philadelphia area, closing costs run about 7% of the value of the house you're buying. In the suburbs, it might run about 6%. So I'll use that scenario again. Somebody's going to buy a $100,000 house, FHA, they need $3,500 down. If you're buying in Philadelphia, for example, you need another 7%, $7,000 for closing costs. We'll talk about those in a different video. So bottom line, you would need $7,000 plus $3,500. You need 7, 8, 9, 10, $10,500 to buy a $100,000 house going FHA. Now that's kind of the bad news, but here's the good news. With an FHA loan, the seller is allowed to pay some of your closing costs. They can pay up to 6% of your closing costs. So let's go back to that $100,000 scenario. You need $11,000, $12,000 to buy the property. The seller can contribute $6,000 to settlement, so the total out-of-pocket money for you buying with an FHA loan would be about $6,000 to buy a $100,000 house. That's pretty good. That's a great way to get into a property. The underwriting standards, or the way that the lenders look at people between a conventional loan and an FHA loan, bottom line is with FHA they're a little more lenient. You can have a little bit more debts. Your credit can be a little bit more dinged. Conventional loans are looking basically to get people well over the 600, 630, 650 level before the rates start to look attractive. Anything less than that, there can be severe penalties. But someone with a 620, 630 FICO score, that's your measurement of your credit. Someone with a 630, 640 can get an FHA loan still with a 3.5% down, still with an attractive rate, and the ratios, you're basically allowed to carry about 5% more debt with your income with FHA versus conventional. So let me kind of sum that up. Somebody goes into a lender and says, I'd like to get a regular loan to buy a house. The lender will try them on for conventional, but if their debts are too high or their credit is too challenged, they would turn you down for a conventional loan. So what's your other option? Well, you can look at the FHA as the next option. And if you qualify under FHA, you're in great position because you can buy it with less money down. Here's kind of the other kind of missing piece of the puzzle that you may or may not be able to follow here. If someone's going to put 20 or 25% down with a conventional loan, they would avoid that private mortgage insurance. If someone put 10%, 20%, 30%, 40%, even 50% down by an FHA, they have private mortgage insurance no matter what. So basically, the real trick is if you want to avoid that private mortgage insurance section in your payment, go conventional and put 20% down. If you can't get to the 20% down, then the FHA is probably the way to go. There's a lot more to know about them. They all have different rules. FHA could have something called a non-owner occupant co-borrower, which is a big word for saying, hey, I can't afford it on myself, but my brother who's got his own house, he'll sign the paperwork too. So you've got someone who doesn't live in the house who can go on the mortgage with you, and that's a beautiful thing to make a transaction work. Also, the FHA allows family members, direct family members, to give a gift of money to you, the borrower. So if you needed $6,000 and you only had $4,000, your mother, family member, could give you another $2,000 to make the transaction. So it's pretty flexible that way.
Okay.
What's the third option we're talking about there?
So the third one is USDA, which I believe stands for United States Department of Agriculture. So how does that apply to mortgages?
Yeah, it sounds kind of funny, doesn't it, that you think of USDA as prime beef or something like that. Well, in certain parts of the region where we are here in the greater Philadelphia region, I'd say if you take Philadelphia, Berks, Bucks, Montgomery, Chester, Delaware, and then in Delaware, Newcastle County, more than 50% of the area, this is all done by a map, is available to a USDA mortgage. So these lines were drawn way back in the past. They haven't been revisited for a long time. Areas that you might not think of as rural, like Downingtown, for example, or Coatesville, up in Montgomery County, just above Doylestown, almost all of Berks County, with the exception of a small part of Pottstown, you can get a USDA mortgage. A lot of lenders don't offer USDA mortgages, so if you go to your local bank or your local mortgage guy, they're not going to tell you about a program that they don't have that somebody else might have. So it's pretty much up to you and a good sharp real estate agent like we have at Artisan Realty to recognize that you may be looking for a house in a USDA area. So what's the benefit? With conventional, you want 20% down, right? With FHA, you want 3.5% down to buy a property. With USDA, you need 0% down. So someone could buy that same $100,000 house with 0% down or no money out of their pocket. The closing costs are still there, right? We're talking about 6% of the amount. So you would need about 6% available for closing costs. In a USDA loan, the seller is able to assist with most of those closing costs. So if we had someone who went in and bought a property in the Downingtown area on US Route 30, which is pretty much considered a busy highway in a busy part of town, it just made it on the map for the USDA territory, and they got into a $200,000 house with $750 out of their pocket. That's it. They wrote a check for $750 at settlement. They got a $200,000 house, and they financed all the house, all the closing costs. It was a beautiful deal. So these are one of those little kind of secret little nuanced areas that experienced realtors know about. Big lenders, national lenders want you to kind of go the expensive route, right? If you go into McDonald's and you ask for the shrimp, they're going to deny you, right? If you go into Bank of America and ask for the USDA loan, they're going to deny you. But in fact, it doesn't mean that great mortgage programs like this aren't available. There's another thing with USDA that you need to be aware of. We talked about that private mortgage insurance, which you need if you have less than 20% down with a conventional loan. The mortgage insurance premium, MIP, same idea with the FHA loans. You need the private mortgage insurance. And then USDA has private mortgage insurance as well because there is no down payment. The lender's in a very risky position. But the cost of that on a monthly basis is about 50% of what an FHA mortgage insurance or private mortgage insurance premium would be. Bottom line, if you take the three payments, the conventional, the FHA, and the USDA, with the USDA, not only do you not have to put down any money, but your cost on your monthly payment will be less because the private mortgage insurance costs are less. So this is not something typically first-time home buyers understand, something they don't really think they want to get into. They want to go find a house. Just let me go online to Zillow and Trulia. Let me find a house. We'll deal with all that stuff later. But a word to the wise, if you could understand where the USDA territories are, understand how FHA works, understand how conventional works, and then you apply that to your real estate search, you're going to make a much smarter decision about the type of house that you're going to choose and the location. For example, on the same street in the Coatesville area, one side of the street is not in the USDA territory. The other side of the street is in the USDA territory. Someone buying a $200,000 house, one person's writing a check for $500, the other one's writing a check for $6,000, and their monthly payment's going to be $100, $150 higher because of the cost of that private mortgage insurance. So these little nuances, these kind of tricks of the trade, are something that you kind of really want to be aware of if you're going out looking for a house. It's not pretty, it's not sexy, it's not something you want to talk about at cocktail parties, but if you're talking about saving $5,000 when you're buying a house cash out of your pocket, saving $150 every month and you're living there for 5 years, you're talking about $10,000, $15,000, $20,000 worth of savings compared to the guy across the street who didn't work with Artisan Realty who told him about all this stuff. So hopefully this a little bit insightful for you, opens up your eyes to a couple different things to take a look at. If you're just thinking about buying a house, this is our commercial here, Artisan Realty. Our offices are in Westchester, but we have agents all around the Philadelphia area, including Philadelphia. We'll be glad to help you and give you advice on these important topics. This is Artisan Radio, signing off.